Welcome to SmithWeekly Discussions, an occasional program for our readers and listeners of SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine the show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion, we want to say thanks for questions coming from our audience at SmithWeekly, including Cindy W. and Dave V. We've got Alex Holmes returning to the show. Alex is CEO and director of Plateau Energy Metals, a lithium uranium development company advancing the Falchani and Macusani projects in southern Peru. The company is listed on the Toronto Venture Exchange under the symbol PLU and also on the US OTC markets under the symbol PLUUF. Alex, welcome back again.
Hi, Andrew. Thank you for having me on again.
So, Alex, you were in Cape Town in DABA conference. What were you doing there? What caught your attention? How did Plateau benefit from the personal meetings and conference?
Yeah, we were down there a couple of reasons. One, the Indaba conference runs that week, which is a big conference that pulls together a lot of European, Australian, and African investors and companies. And the front end of that week is a one-to-one mining investment conference, which is effectively one-on-one meetings every half an hour with investors. So we had a very busy schedule, and the whole idea about going there was to broaden the relationship network and the investor base out into the Australian and European marketplace.
Well, I want to get to the Falchani PEA in a moment, but are there any updates on progress with the concessions dispute?
Well, probably, we're actively working in the judicial system with regards to, getting a second set of injunctions on the concessions. I don't know if listeners saw that we got a injunction on half of the concessions, 17 of the 32 concessions, and that injunction was issued by a court of law, and that judge in that injunction very clearly stated that the company complied with the general mining law, made all the payments on time in accordance with the rules and regulations, and that this appears to be clearly an administrative error. So I think that was it was very positive from our perspective because this is the court of law, and this is the first time the law is sort of voicing their opinion on things. And we included some more details at the bottom of our PEA press release. So our next step is to wait for injunction on the balance, the other 15 of the concessions, and we'll keep charging on. In the meantime, we keep working on the administrative process. And unfortunate disappointment is we're making great progress with the Ministry of Energy and Mines, and the Minister of Energy and Mines resigned this past Monday. So we're waiting for a new minister to be appointed. We don't know who it will be at this point, other than we understand that they'll be looking to source from within the ministry, which is generally a positive from our perspective because we've been doing a lot of work there, educating and informing, and then of course on the concessions issue we're dealing with, that's been a separate matter. But as you can imagine, as the only lithium and uranium company in the country, we've been spending a lot of time at MinAm's offices.
Well, very well, and hopefully the new minister gets up to speed and this issue gets resolved by the end of the year, and they continue to follow through on their promise to have legislation ready on the uranium side for the country. That would also be very useful. So looking forward to seeing how that goes and keeping the heat on progress over on that side of things. So I've not looked at the PEA in depth yet, Alex, so forgive me, but can you give us a complete rundown on the PEA and the various paths within the PEA?
Yeah, absolutely. So I think just, right off the top, we did two cases in our PEA, two scenarios, I should say, consider them a stage 1 and a stage 1 and 2 type project. Those cases, we had our base case, which was based on a mine plan around 100% of the resource within the two concessions that contain the lithium. So that includes one of the concessions that's currently in dispute right now. And then we did what we called an alternative case, which is a mine plan only based on the resource within the Falchani concession, which is 100% or is completely unimpacted by anything. And we wanted to do that so we could give investors a sense of, hey, here's a mine that we can advance without that concession. We're going to push that sort of noise to the background, if you will, while we continue to work through that judicially and with the government, and we hope for a resolution on that sooner rather than later. And then when we're successful, then here's a larger scenario. And effectively, what we were able to show in both cases was we have a long life asset, so 26 years and over 30 years in the alternative in the base case. And that's really important because when you start to talk about the people looking for offtake, they're going to look for long mine lives. We also took a scaled approach to this. So we started out with in phased expansions. And why that's important is, we've got a relatively small lithium market today, call it 300,000 tons of lithium carbonate equivalent, but projected to grow at 20% a year. So by having an asset that we can scale up, and because it's hard rock, and because the process plan can be done in a modular fashion, that allows us to double capacity every 5 or 6 years. And what we did in our alternative case, or call it our stage 1 case, just the Falchani concession, we had 2 ramp ups to about 44,000 tons per year of lithium carbonate. And in the larger case, including both concessions, we went a third step all the way up to 85,000 tons per year. And it's really important to highlight that, because at 85,000 tons per year, that's more than the biggest lithium chemical producer today that exists, and that's all from a single asset. So we think that's a really big strategic advantage. The other thing we were able to demonstrate is we're looking at a very low impurity, battery quality lithium chemical, and it's low cost. It's in the low second quartile, the cost curve. We had Benchmark Minerals do a study for us. They benchmarked us against the peer group, and they actually positioned the project as a probable project within the lithium chemical supply chain, as opposed to possible. And that's a big statement for us, because they look at a number of factors, from the quality of the product to the cost profile to the rates of return and the mine life and the production profile, to be able to make that determination. So, from discovery to being ranked as a probable project in the low second quartile, lower part of the second quartile on the cost curve in 2 years, I think is fantastic. And that's a testament to the team in Peru, 100%. And, I think we've officially put Peru on the map. And then, some of the other things that we looked at were how can we make this a clean, or to use a buzzword, a green mining project. And so we looked at things from how do we handle our waste, and is there ability to recycle the waste process water, and clean energy production at site. And so what we were able to determine is we, through the process route, we have an acid plant that actually generates steam that turns the turbine that generates 18 megawatts of power at the project site, and that's all clean power. And then we have, on our waste side, we recycle about 90% of our process water. And why it's important to mention that is, other than it's the right thing to do, and as you're scoping out projects, this is the time you do those things. But the whole supply chain for lithium chemicals, when you look at what the European car manufacturers are wanting, and what the regulations that they're under are looking for, clean, low carbon footprint supplies of lithium chemicals are going to become a must-have in the next couple of years. And I think certainly something that will help a project stand out when you're looking to talk to off-takers and you're doing the qualification testing and things. So all in all, we're very pleased with the outcome, and we think it checks a lot of the boxes that make it stand out as a strategic project.
And Alex, speak a little bit more to the value proposition, assuming Peru takes away the concessions that are in dispute for the lithium deposit. Just speak to the differences briefly of what you see as value under a scenario where you don't get those concessions, and then under a scenario where things get resolved. Can you just kind of compare or contrast?
Sure, absolutely. So we call that our alternative case PEA, and I also refer to it as our stage 1 project. And the stage 1 project is an 844 million US NPV. The IRR is just under 19%, about 4.5-year payback after tax. Those numbers in terms of IRR and payback are right in line with long life projects and lithium chemical projects like this. By the time we get up to full ramp up, you're looking at about 200 million US a year in after tax free cash flow. And we're just about $4,300 per ton of lithium carbonate. So even in this price environment, at call it $8,500 a ton, in which arguably very few projects will be built to meet that demand, we've got margin, and pretty reasonable margin. And so I think it's important for our stakeholders to see that and look at that and say, okay, well, there's 840 million of NPV. The peer group in the lithium space that we rank ourselves against trades at about 20% of net asset value, or NPV in this case. We're trading at 2%. So I don't expect us to close the gap from 2% to 20% right away, because that would be 10 times where we are today. But I think it's reasonable that we work our way towards, say 10% of NAV as a next step over the next several months. And that would put us, certainly north of $1, closer to $1.50 per share. While we work on the concessions in the background, and then we resolve that, then we've got a stage 1 and 2 project, and that's almost twice the net present value. It's $1.5 billion in NPV, and a project that will ramp up in 1/3 phase, if you will. And I think the after-tax annual free cash flows from that at full ramp up are over $400 million US a year. So this is a sizable project. And interestingly, in that stage 1 and 2 case, which incorporates both concessions, the first 10 years of the mine life are 100% from the Falchani concession, the unimpacted concession. And then over the next 5 years, it's about 60% and so on. So, no matter how we slice it, there's a great project here. And then if we only look at stage 1, well, we're not seeing any value for the exploration potential. So if you recall, in the past, I think we've covered off some of the areas to the west, like Tres Hermanas, which is immediately west. That's on the Falchani concession, and a concession beside it that's unimpacted. And then we've got targets 6 kilometers and 20 kilometers away. So I think we've got a great place to start. We can keep moving forward. We can move what we're dealing with, the concessions, to the background, and try to get investors focused on this disconnected relative value between our stage 1 project and where the peer group's trading.
And how robust is the project on the downside, Alex? Let's say lithium stays stagnant or even goes lower. At what price per ton does this project get stopped?
So I don't have the sensitivities in front of me right at the moment, but $9,000, $8,500, $9,000 per ton project is still something that is, has a lot of strengths to it. For lithium price to go lower, I think what we'd be looking at there is a scenario where no new supply comes on. And what we've already seen in the last 4 months is that projected supply gap, go from 2025 arguably down to 2023, 2022, because so many projects have just either curtailed production, or they've stopped progress, or they're not proceeding with their expansion plans. I'm just going to look at, I just pulled up the sensitivity graph here. Our base case was $12,000 per ton. We ran it all the way down to $10,000 per ton. And, we still have a after-tax NPV at about 430 million if we take 30% off that 12,000. So what does that take us down to? About 8,400, basically. Yep. where the market is today. So we still have a positive NPV and a $430 million NPV. That's on the base case, and about 150 million on the alternative case.
Okay, if lithium is 6,000 a ton, do you see at that point that the project, you guys would reconsider what would be kind of the absolutely last resort as far as on the downside?
Well, on the downside, we still have the uranium project, but I think where we would focus, and that's what we're going to do in 2020 actually, is we're going to focus our attention on optimizing the lithium process step. So we've identified some areas through the first, the 18 months of work that we did, where spending a bit more time, we may be able to chip away at some of the operating and capital cost numbers. And so that potentially changes the dynamics of the project a bit. And the other thing is we're looking at the byproducts. So I'm pretty sure in the last call we talked about what are the possible byproducts from this project. So we started work. We worked off with ANSTO Labs again in October. hoping by the end of March we'll have some news out on the byproducts. And the byproducts here are potassium sulfate, or SOP, which is a fertilizer. It's a specialty chemical fertilizer product. And what we see there is we already bring this into solution because in the rocks. And now we're looking at taking that, and just like we precipitate out the lithium through a slightly different approach, we would precipitate the SOP into a chemical product. And why that's strategic in nature is Peru has 0 domestic sources of SOP. It's 100% imports. It's the fastest growing region in South America. And last year they imported approximately 80,000 tons of SOP. So all of a sudden we could have a domestic source right in the, in close proximity within road trucking distance of the agricultural region on the coast. And SOP is key for things like blueberries and avocados and etc. The other byproduct is cesium and rubidium. Rubidium I won't talk so much about, but cesium is a really interesting one because, again, it's on that list of 34 critical minerals that the U.S. has published. And cesium is something that the U.S. has no domestic supplies of anymore. You've got various forms of cesium. And cesium chemicals, most of it is used in things like air traffic control, security equipment, night vision goggles, and that would be sort of the higher value form of cesium, like a cesium sulfate. And then you've got a cesium formate mud, which is used as a drilling lubricant that's actually leased out versus sold because it's so valuable. So that's already in our rock. We know we pull it into solution. We know we can pull it off to the side, and we're just waiting on that piece of test work to be done by ANSTO to be able to talk to the market about, hey, here's another potential revenue line item for the project, and it's very strategic. And we know that the main source of cesium today is from pollucite mines, which isn't easy, and the world's running out. So here we have something that could bring another angle to the project. So to kind of get back to answering your question, if the byproducts don't work and battery grade lithium chemical price goes to 6,000, which I find highly unlikely, then we focus on recasting the projects and making it, optimizing it. We have some success with the byproducts, and I think at $6,000 per ton lithium carbonate, we still have a project. But we'll do that work first, and then we can talk about that.
Very well. No, that sounds good. And what would you say at this point, their uranium asset, pretty much no valuation reflected in the share price? Is that what you see?
Yeah, no, definitely no valuation reflected there. These concessions, certainly they break up some of the deposits in an odd way, which impacts the mine plan and the PEA. It's only about 35% of the total resource, which is about 120, just over 120 million pounds. So I think we get 0 value for it today. It's still a large resource regardless, with or without the concessions. And with sentiment coming back in uranium when it decides to come back, I think that'll be an opportunity for us to probably retool that project and as we had talked about before, put some capital into it and find ways that we can optimize it and move it forward.
Right, and the way you guys are coming out with the separate project studies makes a lot of sense, especially if you have a suitor that wants to look at the lithium. I think that makes sense to present it that way, so the company can consider separate asset sales going forward as suitors potentially inquire and ask questions. And on that subject, I know you've studied a number of the lithium transactions over the last few years. You've looked at the peer companies. At what stage do you see that the acquirers on that side would be looking at a project like Falchani? Do you think that it's a pre-feasibility stage? Do you see that the company would need to build this out, Alex? Or do you see that a suitor would eventually come along based on what we've seen recently as far as transactions?
Yeah, I think I think a suitor could come along in one of two forms, either someone acquiring 100% of the lithium project, or wanting to be our partners in something and taking, call it, the capital and operating risk off of our capital structure. I think that look, the ore body itself is robust, it's continuous, it's it's not broken up or structurally controlled. It's it doesn't have zones of dikes and things that can do your resource ore body. It's there. It's not going anywhere, and it's large. And from a mining perspective, pretty straightforward to mine. I think where we, and this is the intention for 2020, we spend our time focusing on, okay, how do we make that process route better? And when I say better, I mean, how do we consume less of the consumables, because that drives your operating costs? And can we do things like different crush sizes or shorter leach times that will all feed into different crushing equipment, smaller tanks, less consumables? And the more work we do there, and then we take it to bench scale testing and ultimately pilot scale testing, the more we're bringing data and proof points to potential suitors that look at this and go, okay, the front end of it we understand. There's thousands of tests on the tank leaching side of it, and the downstream part, well, it's the exact same as we already do in the brine projects or in the chemical converters that like Tianqi has, for example, in Australia. So by us eliminating any sense of technical risk on the processing side, that's when I think we start to garner a lot more interest. I think we've done tremendous work so far on it. I think it's already garnering interest. But this next year we'll spend time on finding ways to make it better.
Do you see that coming through in the form of a pre-feasibility study that would happen potentially coming out in 2021? What are the next steps for Falchani?
Yeah, so to take it to pre-feasibility study, we've got the additional process engineering work, and there's engineering work, and then there's infill drilling to take it to a reserve status instead of a resource status. The most capital-intensive part of that is the drilling to convert it to reserves. And so what we're deciding to do is we're going to focus on the front end of that being the processing, advance that along the lines, bring the byproducts in, evaluate that, and start the engineering that you would do anyways for the pre-feasibility, but push the capital in. So that's all, call it high return on investment, low capital, high return on investment type work programs. Right. And then push the infill drilling, the more capital intensive piece of it, back and either into 2021 or into the end of this, back into this year, and really make that decision based on when we start to see the market re-rate us to be more in line with the peer group. And I think a bit of positive movement in the lithium market or the uranium market will help move our market value up. So then we're not raising money at dilutive levels just to infill drill, if you know what I mean. And I think through that plan, because we own our own drill rigs, we can mobilize very quickly. We've got the community support to do it. We won't miss a step in terms of roughly a 15-month timeline to pre-feasibility study.
Yeah, I think that makes a lot of sense. So Alex, there will be some capital needs. Not sure exactly when, but I suspect in the next few months. What will that look like as far as capital need, and what size is needed at this point?
Yeah, so the approach we'll take there is, we're looking to get the information out about the PEA, market the company, meet with investors, and start to try to get a re-rate closer in line with the peer group. And as we do that, we'll make an assessment from time to time on when to look to raise some capital. And really, I would say it really depends on how we do in terms of the market re-rating determines how much capital we raise. Because as owners ourselves, and as I think we have roughly 45% of our registry is with a couple of big brokers at Haywood Securities in Vancouver. We're very cognizant of dilution, so we'll make the judgment call on size based on how we're looking and trading in the market, and go from there. But it's not we're not talking about $20 million or anything like that. We're talking, hopefully in the magnitude of about 5 million, but we'll make that call as we see how the market reacts.
And what is the best way for investors to obtain the PEA documents, Alex? And also, why should they consider the company now?
Best way to obtain them is there's an actual 43101 National Instrument 43101 technical document. We have 45 days to file that, so that'll be out in the not too distant future. But the best thing I would do is if you go to our website, you go to our projects part of our website, and we've put a very robust presentation together on the PEA. which outlines everything that we did working with DRA, our lead engineers. It's about 35, 40 slide presentation that gives you all the information you want about mining planning and the cash flows and the cost profile and all the capital buildup, etc. And that's more or less synthesizes what the 43-101 will tell people. So it's a good place to start. And then, of course, we have our investor presentation, which is a lot higher level. Why I think now is a good time to buy is really just, again, looking at we've come through some noise, some challenges that we're dealing with, and we've just come out with our PEA. People aren't really paying attention. There's a significant disconnect between 2% of NAV in our call it our stage 1 PEA and the peer group trading at about 20% of NAV. There's value there without us doing anything. So, part of what we're doing now is getting out and highlighting that to people. Look at the project. It's got all the merits of a really strong lithium chemical project. Remains to be a good jurisdiction to do business. It's respected by European and American countries for operating best practices when it comes to mining, which you can't say about some jurisdictions. And I think that as we kind of move the project forward and sort of the next couple of catalysts, one of those being the byproducts piece, I think that could really change the value of the project by being able to show those, in particular, those two things, the cesium and the SOP. So that would sum up why I would take a look now.
All right, Alex. Well, it's been a pleasure. Thanks for the update, and looking forward to speaking again soon.
Very good. Thank you, Andrew. Really appreciate it.